Emergency investor warning. Things are not looking good. Everything's deteriorating by the day. NATO goes nuclear on R. We're getting censored by Google, so hopefully everybody knows what R stands for. They've imposed SWIFT ban on the central bank. This was the big move. Only thing that could be worse would be banning energy, which the House of Representatives is going to vote on a bill tomorrow. So Mr. P has no choice now but to go full-blown war. His economy, his stock market, his bond market, and his currency market have been blown to smithereens by Western alliances. And so we're going to see which side China chooses here in a moment. And we're going to see how much pain Europe and America are willing to take to their financial systems as this escalates. And also, what are Mr. P's full intentions? Does he really want to stop at Ukraine, or is he looking to really secure his border? And I'm starting to think he may have aspirations beyond Ukraine at this point. But again, this is really hurting the global economy a lot more than Russia in terms of total dollar pain. So we're seeing the markets down today, and I would blame that on essentially a lot of people having margin calls by being short a bunch of different commodities markets. So oil popped up to over 134 last night. We've got copper skyrocketing up, wheat, just on and on and on. So something's really got to give here. Talks of an energy ban to really cripple R is the next big problem. Now, Europe doesn't want to do this, especially Germany, but the US may make the move tomorrow, or at least start the process, which would be okay if we had Mr. Biden pushing to open up the Keystone Pipeline and dump money into local drilling, but that's not happening. Instead, we're going to other communist countries and begging them for more oil. So this is all very, makes you scratch your head to say the least. Meanwhile, R has captured 2, possibly 3 of the 6 nuclear power plants in Ukraine. And so once they get enough of those power plants, it's really game over. They can shut off all the energy. And I think that the government will have to come to terms and create a ceasefire and do what Russia wants there. So we will see, but let's take a look at their currency, down 40%. The stock market's down actually 80% now. But of course, guess who's going in there and buying up Russian assets? JP Morgan. So these big bankers love to create wars throughout history, and they love to fund both sides. So yeah, it's starting to look like this war was all a big plan, and that getting these energy costs sky high before it occurred was no accident. Meanwhile, we've seen China hoard nearly half of the world's supply of grain over the last year. So clearly they saw this coming. So yeah, we've got a failed peace talk today. There's plans to continue talking next week. But yeah, this is really going to be reaching a boiling point in the very near term. So here's what we're recommending currently. Protect your wealth. This is a simple 3 ETF portfolio right now that could escalate and make even more money than it has so far this year. But I am getting ready to make some pretty significant changes to the portfolio here based on what's happening in the next few weeks. And so we'll look at what those outcomes are. But right now, here's what we're recommending as of March 7th to invest your capital today, right now. So this strategy is up 10% in 2022. Most investors are down at least 10%. The same strategy with very small alterations this year compared to last year returned 233% in 2021. That turns every $10,000 into $33,000. Now, this is what we're recommending for a $10,000 trade alert right now. Okay, if you had 20,000, just double these figures. If you had 100,000, increase it by 10. And of course, if you call Dean, he can send you out a customized trade alert. The first thing we're going to do is protect against what we call margin calls. That's what we're seeing today. Anyone who is short oil, copper, wheat in these various futures markets suddenly could have gone into a negative balance today because we've had all of these go limit up just last night on all this talk of trying to collapse Russia's economy with energy bans, essentially. So when people go negative and they get a margin call, they end up selling everything just to try to get out of that position. So we're seeing lots of volatility across the board today. And that's why we're not panicking and dumping some of our stock positions, especially for the safe growth strategy, on a big down day. I am expecting potentially a big rally in equities very soon, perhaps tomorrow, as people start to cover their hedges. And then we're going to have the FOMC minutes coming out later this month, and we've got the CPI print Thursday. So these could all potentially be relatively bullish opportunities in the short term to reposition our portfolio. I'm also, of course, paying close attention to US policy, European policy, and what exactly Mr. P over there is planning to do. This has definitely gotten way out of hand and much more aggressive than I initially anticipated, or really anyone anticipated. So far, no changes. UVXY is the VIX. It goes up if the SPY ETF goes down. The faster it goes down, the faster this goes up. So we're going to pick up 83 shares of UVXY. That's actually trading at 21.93 today. And it's done a good job protecting our portfolio. Now, we really haven't seen a complete collapse, limit down days in equities, and something that would probably cause the Fed to go from a slower rate hike cycle to going into QE again. So we need some pretty extreme moves in credit markets and the stock market to get that big pivot from them for QE. But if energy costs stay at this level and Mr. P does escalate and NATO refuses to concede to these demands, we could be heading into that type of environment. So at this point, we have not changed anything. We'll be looking for a bounce this month to possibly get into a bigger dollar position if we don't see things starting to move the right way, which means we need to see energy costs go down, and we need to see some diplomacy occurring between these two powers. Otherwise, we'll look at any bounce as a opportunity to rebalance, reposition in case things get much worse. Now, in 2020, when the market went down 30% in a month, UVXY went up 1,100%. So if you had 10% of your portfolio long UVXY, at the peak panic, you're actually up. The other 90% of your portfolio could have gone to zero, and you'd have a return of 10%. Now, it's important to note that for the first 2 weeks of the collapse, you would have still been negative. But it was really that last few weeks when we had extreme panic that you would have gone net positive. So here's a look at the VIX that we're playing, UVXY. It's up 73% this year. Tack on another 10%, I think. So it's up about 80% this year. Doing a phenomenal job. We have a large position in UVXY to protect us right now. Now, the financial system has been weaponized this year, and I don't think there's ever going to be a coming back to where we were before. Two major events occurred. One, Canada began attacking its own citizens for protesting mandates, and then two, the Western world completely blew up Russia's economy in less than a week by, again, weaponizing the dollar. So this is a huge reason to be bullish on cryptocurrencies. Wartime typically ends up with a lot more money spending, and again, very inflationary period of time. So we're really bullish on cryptocurrencies. It's been really quite a sell-off in Ethereum over the last 3 months. But it's normal. It's really normal to see around 50% volatility in cryptocurrencies. We're right at that drawdown that's typical. And I believe this is a beautiful time to load up on our favorite position, which is ETHE. Over the next 10 years, I see this being your best performing growth asset, blowing away assets like the Nasdaq or Apple or Tesla. Okay, so this is where we see extreme growth opportunity. It's less than a decade old, and it's having massive, massive adoption. Now, we did get news today, which is probably why we're getting a little volatility in crypto space, that Biden's going to give out its executive order to give instructions to various parts of the government to create regulations revolving around crypto. So I think what we're basically going to see is the ability to give centralized exchanges a blacklist of illegal addresses and for them to block those funds from being converted into the dollar. I don't see them being able to do much else at this point. So we will keep a lookout on it. But in general, I think this is your single best asset to build upon over the next decade. And we're talking some extreme returns coming out by just buying and holding this single asset. In fact, our whole strategy revolves around protecting our growth asset, which is Ethereum. Now, if you've been holding on to Ethereum and ignoring the volatility since 2017, you're already up 15,000%, and you're sitting on a larger than normal drawdown for this asset. Also, when you buy ETHE today, it's trading at a 30% discount compared to the par value of this Grayscale trust. So it's a massive trust called Grayscale. They raised money one time, bought a bunch of Ethereum, and then put this as an OTC stock. And so right now, if you look at the value of Ethereum compared to the value of this OTC stock, it's trading at a fantastic 30% discount. So it's actually acting like a slightly leveraged product. You lose a little more on the downside, but you make more on the upside. So that's going to be our favorite play for growth in our high risk portfolio, at least for the next decade. And so really a lot of these tech giants are taking 2 to 3 to 4 decades to really saturate their markets. This product's just getting started. It has real adoption, real thriving market growing on the backbone of the Ethereum blockchain. So that's our growth asset. And then the third hedge is what can hurt the bond market. So when people run out of dollars and start to have insolvencies, you tend to hit the stock market. So UVXY is protecting us against volatility in the stock market. The bond market does not like inflation and energy. And so that's exactly what Boyle does for us. So this is playing US natural gas prices, which are trading something like 1/10, okay, 1/10 that of European natural gas prices. So the play here is that Europe's going to start to order more of its natural gas from the US, driving our prices up and trying to get off of natural gas from Russia, which currently controls 45% of their entire supply. So this puppy not only could double or triple, it could be going skyrocketing if there's not a diplomacy in the very near term. So we remain very constructive, very bullish on Boyle. Pretty much every other energy products trading at extreme ridiculous highs, and natural gas is yet to break into new highs. So, and again, this is the US natural gas prices. So 93 shares of Boyle. Here's a look at that chart. So you can see how it's played out so far this year. Now, if you go back last year, without war, this was already trading in the 95 range just because of a shortage of energy in Europe in general. If we look at the breakdown, we're now at a 17% UVXY position. So if we have a complete collapse in stocks and they go falling off a cliff, limit down type days, we're more than hedged. We're way over that 10% mark. We're at the 17% mark. And even on the big up days in stocks, you've seen me not change the positioning. We haven't dumped our UVXY because we know the coast is not clear at this point. We currently have a 42% position in Ethereum with Grayscale Trust ETHE. Now remember, that likes interest rates trading flat or lower in general. And Its biggest threats are margin calls, which create systemic selling. So UVXY protects against that, and then against inflation, which can collapse the bond market with Boyle. So bottom line is we're going to sit in this positioning, and we're going to wait for a de-escalation. And then we're going to dump UVXY, we're going to dump Boyle, and we're going to go big time into Ethereum. I have a few other plays. I want to short oil with ticker DRIP. And I'm looking at maybe buying up cheap energy companies in Russia with the ticker RSX. And it's trading at 80% discount. So not yet. At this point, it looks like things are going to get worse before they get better. But perhaps Russia is able to take a few more of the nuclear power plants and it's game over. And maybe there's a pause in this war. So carefully monitoring the situation. So far, this exact setup's been working very well. And so we're just carefully monitoring the situation as we progress here. Now, again, if a de-escalation is in the cards, expect energy costs to sell off rapidly. And this would cause bond yields to fall in the short term. So that's our expectation. And again, if these prices remain at this level, it will collapse economies just on its own. So these are at very unhealthy levels that are not sustainable. So we have been smart not to enter the short oil position Friday when we were talking about it, because we'd be sitting on a massive loss. But at this point, that does seem to be the single most profitable position in the very short term, is to figure out when to go and pick up DRIP and short oil, I would say back down to the 80 level, assuming that it's a healthy de-escalation and not a collapse of the global economy, because there's no diplomacy occurring. Now, here's a look at the TLT. This is the bond market. We're seeing stress in all the bond markets today. TLT is down 0.5. LQD, the investment grade bond, is down 1.1, and the junk bond market's down 0.9. Plus, the 2-year bond has jumped up 4% today on the U.S. Treasury, going to 1.5. So most likely, we're going to see a 25 basis point rate hike in about 2 weeks here. Now, if energy costs can come down, the rest of the economy is showing massive signs of deflation across the board. So it's really just food and energy. If we can get those coming down, I'm very confident we'll see bond yields calm down. They've been crashing for about 3 months now, creating volatility in stocks. I believe that move is dramatically overdone. The only catch is these energy costs will be massive problem for the CPI, which we get the next print come Thursday, which I do expect to go up from the last print. We'll talk about that when we get to the charts. So in general, we want to bet that as soon as this de-escalates, you're going to get the best return in the Nasdaq and Ethereum, so both growth assets. Now for our safe growth strategy, we'll be buying Bitcoin and the Nasdaq. For our high risk, we are concentrating our complete effort on Ethereum, which has probably the best risk to reward ratio of any asset out there today. China had a meeting about its goals for its economy. So they've set a growth target of 5.5%. And it's a little bit lower than they've done before. They've been averaging like 7, so it's a little bit lower. If energy costs remain this high and food costs, they're going to have to print a lot more money to keep the economy trucking along. Either way, we're starting to see China expand credit in this period as the US is slowing down. And with the disruptions in Europe, most likely they will have to be very, very gentle with any kind of tightening, and if anything, go back into QE. Final point, last time the US tightened while China expanded credit was 2016 to 2018. Bitcoin returned 4,400%. In general, when we do quantitative easing, initially it's really nasty for bonds, forces everybody into commodities and stocks and cryptocurrencies. And what's funny is initially when you do quantitative tightening, it's the same outcome. It's negative for bonds. It's forcing bonds to lose money until they stop doing that rate hike cycle. So that's why you can understand that forcing negative returns in the bond market caused an asset like Bitcoin to go up during a tightening cycle, which may be counterintuitive because they did just that. They hiked rates and they let the balance sheet run off, and you had this phenomenal return in Bitcoin. And here's a chart. So this is right when Trump came into office, they began to hike interest rates and allow the quantitative tightening to occur by letting the balance sheet sell off and not reinvest the bonds. And so it worked until the bond market became attractive, overly attractive. And of course, we know what happens after that. This chart went the exact opposite way, and Bitcoin crashed from 20,000 down to, I think, about 4,000. So that's how we're looking at the markets right now. The global economy has been slowing down, and inflation, I was thinking, could peak out by March. But I'm going to say as long as oil's above 100, it's not going to slow down as fast as I was anticipating. So it's going to be very important for trying to read the Federal Reserve and how they're going to react to this wartime situation. So we may need to prepare for a higher than expected inflation rate all the way through June, and carefully listen to Mr. Powell as to whether or not he's going to remain easy with monetary policy when the problems are on the supply side and not the demand side in terms of the energy crisis we're facing. So we look at the big picture. Cash is trash. If we're going to go to World War III, I want to get us into cash. Okay, so I'm looking for a bounce, and I'm looking to see if these guys are going to have diplomacy or not in terms of getting repositioned here. Right now, I don't want to do it when stocks have already fallen this much. So at this point, we're just staying tight, and we're going to wait for the inflation print Thursday, and then the Powell speech would be the next week. So the next 2 weeks could potentially have some pretty bullish catalysts to get stocks back up. And this would really be more important for the safe growth strategy, which has exposure to Asia, emerging markets, and US stocks. Bonds are garbage right now. So if we look at the 30-year, we're getting paid 2.1%, and inflation's at 7%. So that's just not a good bet. And wartime could increase the inflation problems on the supply side and cause the government to run bigger deficits. So it just leaves you with very few places to park cash right now. That's why we currently remain long stocks, cryptos, and commodities, although those commodities are way overbought. The first move I would like to do is cash out our crash insurance and our commodity play, and then go big on, again, Nasdaq and crypto. But we need the catalyst to cause this cool off, which would be most likely diplomacy, or the US going full scale and creating its own oil supply here very soon, but they don't even talk about that. So that's what we're looking for. If oil goes to 150, I'll most likely enter the short position immediately, because I do think that would snap markets right in half. So very important to join our webinars every Monday, Wednesday, Friday, and be ready for sell alerts. The current positioning is done very well, and it could do even better in the near term, but we need to know when to pull the trigger, because again, these energy costs are not sustainable. And if there's not a de-escalation via diplomacy, there'll most likely be a crash in the global economy due to these unsustainable energy costs. So don't miss the sell alert. If you're on the trial, you'll miss that. You just get the entry points. You have to upgrade. Call Dean at 505-322-7515 to upgrade your free trial.
Yeah, you know what, Jason? Steve M actually put in some great questions too. If you want to cover those as well.
Sure, let me check it out. Okay, let's see. So,
and then let's see. Sass had a good comment too. Hey, Sass, hope all is well. Yep, and then someone was asking why Boyle was that. Yeah, there's a couple of good questions in there too, Jay.
Returning visitor.
Okay, someone says what's to replace bonds? Well, I guess gold's starting to replace bonds in some portfolios. We're keeping an eye on that. Okay, SAS says we've had volatility this year. You're right, we sure have SAS. Steven says de-escalation can only take place when Ukraine's military is forced to peace. When does Jason think that will occur? I think we're going to have I think something's going to happen within 30 days or less at this point. And either Ukraine gives up or Russia gets very aggressive. Someone asked why oil's down 5% today. So it's yeah, it's U.S. natural gas prices, but it's a futures curve. So it's really complex. In general, what you need to realize is Europe's going to cut off its purchases to Russia as fast as it can and reroute them to America. So as long as this drama is playing out, we want to be long oil. It's likely to go up significantly higher from here. Steven says, how does Ameritrade protect PB Grayscale Trust from Biden's executive orders? Yeah, I think the executive orders are going to ask centralized exchanges to essentially block people from converting into the dollar with any address they've marked as some sort of terrorist or criminal actor. Rock says, what's everybody's pissed off about their EDC? You guys got to realize Russia got pulled out of emerging markets. And so it's creating some volatility. But that's okay. Long term, I still see that being our best performing asset over this decade. So if anything, we're going to buy more EDC unless we think World War III is about to break out. People ask about energy. We want to buy NRGU again once oil has a significant sell-off, because these prices are going to be demand destructive. So NRGU is going to do well if oil companies are making a lot of money. And so 100 I would be pretty happy with, but 120 and the risk going to 150, that will kill demand and the expectation of profits of these companies. So right now we're long the price of natural gas. We're not betting on a natural gas company. But yeah, something's got to give. These prices cannot remain at this level. All right, let's check out the headlines and then we'll go into some charts. But yeah, there's a lot of volatility. There's explainable events. Emerging markets had to pull out the whole Russian index. So that's created some pretty extreme volatility in emerging markets. That's one. Two, the prices of energy going limit up on all kinds of different products is creating margin calls today. So not the good time to adjust any position that's down. And it's also not a good time to take profits on UVXY or BOIL yet, because the same thing that's causing this volatility could get worse before it improves. So it's a good day to realize that we were hedged and it's reduced the pain, and we should just sit tight and understand that this conflict is not fixed at all and could get potentially worse. And then that's when we'd want to sell our UVXY and our BOIL. China's not going to go into Taiwan. That absolutely won't happen. See, China doesn't have energy security or food security. So there's zero chance they're going to do that right now. China would be better off doing that when cost of food and energy was cheap. So this was a really good time for R to make his move, or P, because energy costs are so high and that's what they produce. This would be a terrible time for China to do anything because the opposite situation is occurring right now. Yeah, I think the big questions are, will Ukraine surrender? And if they don't and they get wiped out, will Mr. Putin stop there, or is he going to completely fortify his border? Which would mean, I think, taking over like 3 more countries. And if he does that, will we go to a more large-scale war? So Russia is now cutting off the internet to all of Russia and going to their own DNS. Credit card companies, Netflix, Twitter, Facebook, completely getting out of Russia. US is about to ban their energy without solving the problem first in terms of creating more supply. So at this point, definitely a good reason to stay long our two hedges. Consumer credit fell 6 billion from 22 billion, just hit today. This is a really neat thread that's kind of a big pitch for Bitcoin, but it also gives you an idea of why war in the long run ends up creating more debt and makes inflationary assets like stocks go up. So typically war leads to higher stock prices in many cases. So this guy's name is Alex Gladstein. He says, my new essay, The Invisible Cost of War in the Age of Quantitative Easing, is live. P was able to invade U because there are no checks on his tyrannical power. Democracies in theory should be more constrained in war making, but are they? One of the greatest argued strengths of democracy is democratic peace theory. DPT observes that democracies are less likely to fight, and especially less likely to fight each other. Democratize the world, get world peace. But this story has one big flaw: fiat central banking. Post 1971, America, in the role of the world's leading democracy and guarantor of the international system, has transformed how it finances war. In the first half of the 20th century, wars were fought with taxes and liberty bonds. World War II was 50% financed by taxes, and the Korean War 100%. Post 1971, everything changed. There would be no more war taxes after 1968 and no more liberty bonds. War was placed on a national credit card. America's post 9/11 wars have been paid for exclusively by borrowing. Combined with the end to conscription and the rise of drones and robotics, borrowing for war instead of taxing or raising money specifically for it has led to a population that is not engaged with and knows very little about wars, its government's wages across the world. For example, how many Americans know about Operation Inherent Resolve? It's a newer 8-year war launched by Obama that cost tens of billions of dollars and is being fought in Syria, Iraq, and Libya, paid for entirely by borrowing from the future. In order to fight the US government's post 9/11 credit card wars, the American people have already paid $1 trillion in interest alone, just the money that the government borrowed to fight those wars. This is not a widely discussed fact. Some may say it is hidden. US entitlements remain largely paid by taxes, but when it comes to exotic forever wars, they're paid by credit. This is possible because interest rates on US debt are near zero and cheap to pay back. But if rates went to 3%, US would owe 25% of its tax revenues to interest. The Fed has purchased $9 trillion of US debt and financial assets since 2008. Since March of 2020, the Fed has purchased 4.7 million of assets per minute. This puts upward pressure on the prices of US debt and downward pressure on rates, reducing the cost of borrowing. Of course, US Treasuries remain the most desired financial collateral in the world, but 15 years of enormous buying pressure from the buyer of last resort to the tune of almost 10 trillion has had an undeniable impact on the market, mechanically and psychologically. Without quantitative easing and zero interest rates, US interest rates would be higher and the forever wars would be cut shorter. Of course, proponents of QE and debt monetization do not talk about foreign policy. In Stephanie Kelton's 300-page The Deficit Myth, the words Iraq and Afghanistan do not appear. It's true that the post-1971 fiat standard monetary system has made it possible to pay for more social welfare in the US, but has also made it possible to pay for a lot more sustained war than otherwise possible. The latter is almost never discussed. Zero interest rate policy and quantitative easing have other negative externalities for Americans. They may make it possible to continue fighting forever wars without needing to raise taxes or raise war-specific bonds, but they also cause asset inflation and increase inequality. In the 1990s, the 1% owned 23% of American household wealth. Today, after 3 decades of easy monetary policy with interest rates falling from 8% to 0, the 1% now own 32%. Meanwhile, the bottom 90% saw their wealth share decline from 40% to less than 30%. In a country where the top 10% own almost 90% of the stocks, asset inflation is a redistributionary phenomenon. But extreme inequality isn't the only major downside of debt finance spending. In the late 1960s, as the gold standard came to an end and the fiat standard began, in the mid 80s and again in the early 2000s, the US embarked on a series of debt financed military buildups. Each one ended in a catastrophic financial crisis. The first was followed by a run on the dollar, the Nixon shock, the end of the gold standard, and dollar devaluation. The second was followed by the savings and loan crisis and Black Monday. The third was followed by the subprime triggered global financial crisis. In the fiat age, debt financed military buildups cause crashes, and today's GWOT, America, is now at an all-time high of debt to GDP ratio topping 130%. Even if we stop them today, we'll owe $2 trillion on post 9/11 war spending by 2030 and $6 trillion by 2050. It's possible that the interest we owe on post 9/11 wars eventually eclipses actual spending on these wars. And this comes at a time when demand for US debt has peaked and the US dollar system remains under enormous stress, with Russia and China perhaps splitting away. Smith, Mill, and Keynes all argued borrowing for war was a bad idea, especially if it caused rates to rise. But America figured out a magic trick to borrow for sustained war with low rates. As Cicero said, nervi belli panusi infinita, I'm sure I messed that up. The sinews of war are infinite money. So how do we prevent the credit card wars from further eroding democracy? Conscription could work, but it's politically impossible and morally dubious. War taxes plus Liberty bonds could work, but these seem politically impossible too. Would a war bond even pass the ESG test? One option would be to move away from the fiat standard to a new kind of more restrained monetary standard. It may sound far-fetched, and central banks would never choose it willingly, but many of us believe a Bitcoin standard is a future possibility. The neutral, open, predictably scarce, and decentralized money has grown from an idea to $1 trillion asset and could potentially see a wave of global adoption in the next decade amidst high inflation, fiat devaluation, and financial repression. It's quite a little piece. I liked this whole little thread.
It's phenomenal, Jason.
Yeah, pretty
phenomenal. Good. Huh? Yeah.
If the world's leading democracies couldn't simply issue bonds with one hand and buy them with the other, if its central bank and private sector were constrained by a Bitcoin position, then there would be a spending triage. Exotic wars might be one of the first things to go. The US earns enough income to pay for most of its entitlements, but we borrow to fight the forever wars. Defensive or just wars could be still fought and waged in a Bitcoin standard, but unpopular ones could not be sustained. The cost of war would be invisible no longer. Okay, so just a little thread we picked up there that I felt worth showing. Let's see. Reuters says Russia could cut natural gas via Nord Stream 1 to Germany. I don't think they're really interested in doing that. What I think Russia is enjoying is markets driving these prices higher all on their own, and they want to just keep making as much money as they can to survive while they try to push their border, and that seems to be the plan. So I'm not expecting Russia to literally cut off energy to Europe unless something very, very crazy happens. Now we've got Mark Rubio saying there's going to be some sort of false flag nuclear attack in Ukraine and that Russia's setting it up. So at this point, nothing would surprise me. This fellow says, if Russia offered a choice, Nord Stream 2 or nothing, which would Europe prefer? Nord Stream 2 would cut off Ukraine from delivering gas to Germany. and that was stopped in this escalation. Here's a look at wheat futures going straight up. So if we're looking at volatility today, it's clearly the bond market's upset with all these different inflation inputs going skyrocketing up. So we've got every bond market down in the US, plus we have limit up on just about every futures market. So could take a good week to see all the people who got blown out, all these bodies rising up from the ocean. So we want to just be very cautious this week. Lynn Alden says people say energy stocks are overbought. In the near term, probably yes, but when zooming out, not really. This is looking at what percentage of the S&P 500 is in energy, and it's at a relatively very low position. And if we think we're headed towards a 2008 sort of fiasco, we could be at the very start of a run-up in energy products. Some footage. It looks like Russia's been really having a hard time making their way into the center of Ukraine. But again, if they can capture enough of the power plants, then they can turn the lights off. So we'll see how this plays out. US House to vote on removing trade relations with Russia and Belarus tomorrow. Oh, that would be a disaster, in my opinion, for energy markets, thus the bond market. So that's why we're not selling UVXY right now. So Russia's not turned off the tap on natural gas or oil. With today's data, supply has not fallen. And in fact, Russian companies offered discounts of around 15%. And we had some big player go in there and get oil at $30 off. It was Chevron. Meanwhile, we've got the big banks buying up Russian assets right now, corporate debt and stocks. Some more footage of Russian military getting blown up. Ukraine's estimating their infrastructure damage is at 10 billion so far. And the House is also making a bill to send over, I think, 6 billion. EU aims to cut dependence on Russian gas by 80% in 2022. So this gives oil a long ramp up. We could be in this position a lot longer, depending on how slow or fast this war escalates or de-escalates. Joe, man, this is bipartisan. So the U.S. government wants war. Bottom line, State of Union was a big pitch for war. Both sides of the aisle are pro-war. Nobody in the US media has explained what the hell Russia wants or why this war is even taking place. All they say is Mr. P is evil and we got to stop him. And that's that. So becoming less and less convinced there's going to be a de-escalation unless there's enough pain to Western civilization. And the pain's going to come with oil staying above 120 for a prolonged period of time. Okay, Valena Charkorova says, here are two scenarios. Either US and China make collectively a move on Russia and fragment it into pieces. Probably not going to happen. Or China helps Russia survive the US hit and builds further counterweight to America altogether. Bingo, that's what I believe is really happening right now. Russia's disconnecting from the external internet on March 11th. So big moves, permanent moves. They also switched over to the Chinese credit card system as Visa and MasterCard have pulled out, and Netflix. So yeah, Russia's being canceled completely. Thomas Massey says, imagine thinking that canceling Putin's and every Russian citizen's Netflix subscription will help end the war. In fact, these type of moves seem to be making them more and more popular for your average Joe Russian. They also wrote up a conscription document, which could be put to work in the next few weeks. So China's economic policy decided 5.5% growth target, a little bit less than we've seen in the past. They're probably worried about the inflation out there with too aggressive of a credit. Here's his summary. The war will affect Chinese growth mostly through high energy prices. If oil quickly drops below 100, then 5.5% is unlikely to require large stimulus. But if oil remains above 100, Beijing will have to ramp up printing money essentially. And their currency is very strong. So they probably could get away with that right now. So far, China will continue to cooperate with Russia, big surprise, and not impose unilateral sanctions as the West did. Yeah, surprise, surprise. Kremlin spokesman says Ukraine must amend the constitution and reject claims to enter any bloc. Ukraine must recognize Crimea as Russian and Donetsk and Lugansk as independent states. If these conditions are met, Russian military action will stop in a moment. So there's a chance for a de-escalation. JP Morgan strategists are advising clients to pick up some beaten down Russian assets on the cheap, touting the bonds of Russian companies with significant international operations was the best way to profit from distressed pricing. Albert says Blinken and Biden won't allow this deal to go through yet. Independence of those breakaway republics is a no-go. Marco Rubio is tweeting about every 5 seconds on this. Extremely pro-war, telling us to get ready for a nuclear bomb to go off and that it's a false flag, essentially. Michael Waller says it's becoming clear now why communist China has been hoarding the world's protein and grain supplies. And funny enough, guess who's been buying up massive amounts of US farmland a year before this breaks out?
I knew something was up with that.
Mr. Bill Gates. Yeah. Jack Sobiek says Biden is buying Russian oil while sending aid to Ukraine. He's actually funding both sides of the conflict, although that's about to change possibly tomorrow. Final internal draft from Russia's Lavrov announcing a draft for the Russian military, 15 to 72 years old. They put this out for review, and then a declaration of war is the final step to enforce this. WTI and Brent are up 10% this morning. More disruptions in Libya. I think it took 500,000 barrels a day offline. Potential ban on Russian imports. Iranian nuclear talks clouded by Russian demands. Why are the Russians dealing with our oil and nuclear talks with Iran and a very ambitious Chinese GDP target? Okay, I think that gives you a pretty good feel for the state of the world here. Okay, the war in EU carries on, now fast approaching the 2-week mark. The lack of success by our military has been very surprising and very damaging to Moscow's reputation. The West continues to pile on sanctions, which begins to really bite into P's domestic power. However, the overindulgence by the West political factions, cancel culture, and the overly successful defense by the EU military will eventually force P to sink in more troops and resources to find a success in this adventure. U's defenses were too successful. Now Moscow must find a victory. Who in the world would have guessed 20% of R's active fighters in U would die in a week? Yeah, not looking good. Less than a week, US has pushed 17,000 anti-tank weapons, Javelin missiles over the border of Poland and Romania. Okay, Marco Rubio, like I said a week ago, R has been planning some sort of either a chemical weapon, a biological weapon, a nuclear weapon. I guess there's like 7 of our bio labs in Ukraine that are being targeted as a false flag. So we will see. Okay, let's look at some markets. So the 2-year is what's really letting us predict the interest rates. So at this point, the neutral rate is 6 rate hikes to get up to 1.5. And we're expecting a 25 basis point hike in March for that to be a dovish surprise that the bond market likes in the short term instead of 50 basis points. And due to the slope, the crashing US GDP from the Atlanta Fed, crashing housing sales, massive inventory builds. The only thing that's really screwing with the CPI now is the energy and food costs. And that seems like it's going to be disrupted for quite some time. But this is the smallest this spread has been. So this is what they talk about with yield curve inverting. And so we can see it was really wide way out here, and it's been getting smaller and smaller and smaller. Now, what ends up crashing the markets typically is when the 30-year goes up to such an attractive price that it starts to really destruct every other market around it. So right now, we're just not anywhere near that level to be worried about the bond market causing the pain. 25 basis point rate hike is what I'm expecting for the March 16th meeting. Reverse repo still at 1.4 trillion, down from 1.6. So this is like the QE buffer. Here's a look at some ways to play the crisis here. And so we're in boil, which from this date is underperformed NRGU. Unfortunately, we sold NRGU too early. We jumped into boil. We had this huge double and it crashed right back down, and now it's regained about half of that. But if Europe's going to stop buying Russian oil or natural gas, that's the headline we want. So from March, for the first 8 days or 7 days, USO, NRGU, and boil are all trading pretty similar in return. But the big shocks so far have been to the price of oil going to as high as 136. So I think the highest it could possibly go without major disruptions would be in that $150 to $200 range, and I would immediately want to short that. Boil, again, we need to wait for these European countries to reroute purchases to US. So it's going to take some time. So boil could actually do really well if this war is slowly drawn out, nice and boring, which is kind of the pace we've come into so far. So we might be holding boil a lot longer than we thought. Originally, I was saying we'd be selling it in March or late February. Okay, we've got lumber futures going back up and oil. So there's really no sign. All the futures markets going just straight up right now. Copper futures, here's that big move here. Now, if we zoom out, now it's interesting to see that big dump right here. I'll have to see what exactly caused that. But in general, what we're seeing is copper go up faster than gold, but gold's giving it a run for its money. This is a tool that's used to predict interest rates. They call it the gold to copper ratio, or Dr. Copper. And so right now they're going up about the same pace. So this is not giving us a signal for higher or lower interest rates. And normally the bonds would be a good hedge for war, except the impact of this war is higher inflation, which is bad for bonds. So I'm not very inclined to buy treasuries for us if we think stocks could have more pain than we're already experiencing. So I'm more interested in the dollar at this point. Okay, Baltic Dry Index has stopped its crash, but way lower prices, showing that if energy costs can come down, then the CPI can come down. If we zoom out a little bit here, we can see in general, We've had interest rates on the triple T rise, so 20% gain on the leveraged long end. This has driven energy costs way higher. NRGU ups big, and the Nasdaq over this period down 18%. So predicting those interest rates is critical. In general, I think interest rates are going to stay flat or fall in the near term as energy costs eventually come back down. Now here's a look at a potential play for us. So we can see RSX highly correlated to the value of oil. And then with all these sanctions, they've been knocked down 80%. Okay, and we're already seeing the big greedy banks start to gobble up Russian assets. So I'm not making that move now, but I would like to simultaneously buy RSX and short oil, as the two positions would hedge one another. But again, we need to be patient on that, because I'm afraid oil could go much higher and Russia perhaps even lower if this conflict does get worse. Here's a look at emerging markets and the Nasdaq. Emerging markets was outperforming the Nasdaq, and then they stripped Russia out of it, and it created some pretty extreme volatility. But in the general, we're looking at the U.S. tightening and perhaps having a gridlock government if the Republicans take hold. So less spending and tighter monetary conditions coming up for the US. Meanwhile, Europe and Asia are likely to keep QE going and spend more money. So we're remaining constructive on emerging markets over US markets as soon as this conflict slows down here. Here's a look at the Russell 2000. No big pain. It had gone from a channel much lower, but so far it's hanging in there, and no big alarm bells from there. Here's Europe taking a big hit. You can just see it just falling off a cliff here. We do have exposure to that in safe growth. But again, this is going to lead to more QE and more government spending. So I think this is not the best time to change that positioning unless we think all hell's about to break loose. And if all hell's about to break loose, I would rather reposition on a dead count bounce, which I think is going to occur in the next 2 to 3 weeks. So I expect stocks to go back up in the next few weeks, potentially with the CPI on Thursday and a more dovish response from Powell next week, and maybe some positive diplomacy occurring. And if the diplomacy is not occurring and it looks like things are going to escalate further, we can go into a bigger dollar position after we get a bounce. So I just would not want to make this adjustment right now. Okay, we got DXY at 99. For the crypto to go up or even trade flat while the dollar's rocketing higher is very good sign for our positions in cryptocurrencies. Again, if a de-escalation occurs, dollar's going to fall, and it's going to make all of our crypto positions skyrocket. So very happy with the Bitcoin and Ethereum performance with all this chaos in the dollar and the bond markets and the commodities markets. There's that Chinese currency just getting stronger every day. So they definitely have some room to print money and weaken their currency a little bit. Here's the tech carnage. So if we look at the peak carnage, so you can see in yellow, interest rates went up. And then we've got volatility, 22% down in NVIDIA. I believe some of the metals used in chips are coming out of Ukraine and Russia also. So this an even bigger problem for supply chains now. JP Morgan not keeping up with these rising rates. Interesting. We do have Bank of America doing well over this period compared to the Nasdaq, and Mr. Warren Buffett's up 9%. So everybody was giving him such a hard time, underperforming in the lockdown period. In this chart, we're comparing Taiwan Semiconductors to Alibaba and Tencent, and we're looking for a signal that China is going to aggressively expand credit and push through policies that are bullish for their stock market. And so far, they're not outperforming Taiwan Semiconductor. So still patiently waiting for that to occur, and perhaps the MCHI indexes all stripping out all Russian companies from emerging markets ETF is the root cause of this extra volatility in Asia currently. Okay, Toyota's taken a big beating, now down 25%. And this does make sense with that sell-off in Europe, which this is a big part of that index. Let's get worried if Toyota breaks 52 for some sort of canary in the coal mine that the super rich are fleeting. Here's Exxon, can't stop going up. Its record price was at 104. And again, I think this is overdone. So soon as we see a de-escalation, I really want to short oil and wait for it to come back down to the 80 range, and then we'll pick back up in our GU. But at this point, it's just dramatically overdone due to the war issues. All right, here's our yield curve spread on the 10 and 2-year. And so it's, when it goes negative, it predicts a recession 16 months out. So it's actually a very good period in general to be long stocks until the yield curve steepens. So that means that long end, or the TLT, crashes. So right now the TLT is just not crashing, and more likely it's going to have lower yields in the short term as energy costs come down. But that's what we should expect if this inverts and then starts to rise again. And it's predicted just about every recession 12 to 16 months out. So it's not something we want to react to right now. All right, let's look at the pain today. So all three of these critical bond markets are selling off. This could cause the Fed to get more dovish faster than stocks going down. So we're seeing some pain. Let me go to a 5-minute chart. So the spiking energy costs are definitely not good for bond markets. And so we're seeing a little bit of pain in all three of them today after that huge shock to futures markets overnight. Here's the Tesla Ethereum correlation. So they don't trade exactly the same, but very similar. And this chart to me indicates that Ethereum could be catching up to the value of Tesla on a percent change basis. So beautiful day to load up on your Ethereum position after a shock like the oil cost of last night. All right, let's look at this gold and silver play. So I'll go from this low point. If you go to October of 2019, UGL has up to 100% return, and silver had at one point a 180% return. We actually had played gold all the way near the top, got out, and we've been sitting on the sideline ever since. So this could be an interesting play. I'm definitely contemplating a gold or silver play for our portfolios. The longer this, if the war is going to go on for a long time and the Fed's going to be very dovish with policy and let inflation run hot, then I think this could be a very good play. But it's already gone up a lot, so I'm not making any moves currently. Here's Treasuries against the dollar. You can see this correlation. And again, TMF is a leveraged TLT product. And in general, we've been seeing a lot of volatility in bonds. So if I zoom out a bit, last year into March, we had this bond crash, and the rest of the year, we had a bond rally. And then the exact same period, we had a bond crash. Are we on the brink of a bond rally, a falling dollar? That's what I'm expecting, as long as we don't go to World War III here. and cut off energy to the world. This chart, we're looking at the RMX for rare earth metals, uranium, URA, copper miners. We're currently in REMX and uranium. If we zoom out a bit, we get a feel for how well these have performed. Extremely well, highly correlated to interest rates. So in general, we're expecting interest rates to find a peak price within 2 to 3 years. And only in this short term, I'm expecting yields to fall a bit as energy costs come back down. Let's take a look at our ugly yield curve. So we've got an inverted yield curve on the 20 and 30 year, which I don't make much of. The bigger problem is the 2 year is approaching the 10 year. And boy, the 7 and 10 year are almost inverted as well. So the short-term inflation is expecting that the Fed's going to have to fight it with rate hikes. But then the longer expectation of inflation is that you're going to crash the economy by doing so, which is why they're predicting a recession 16 months out, which happens to be close to that 2-year timeline. Now, the shape the Fed wants it to be is, right here. So right before Trump left office and did $1 trillion in stimulus, and Biden came in and did $2 trillion, that's where it looks like we really put too much money in the system and screwed up the bond market. Okay, so this is what they want it to look like. This is October of 2020. Then they go past $3 trillion in stimulus that arguably we didn't need. And look what happened to the yield curve. So they've got a huge problem on their hands. Here's the Vix Futures. So it's in backwardation. This is good. If we get more pain in the markets, UVXY is primed to skyrocket with this shape of the futures. The opposite's true as well. So if markets bounce, we could see some pretty big drawdowns on UVXY. But it's okay because we're in these very leveraged products, whether you're in safe growth or you're in high risk. If we get energy costs to go down and bond yields to fall, our long positions will offset the drawdown on UVXY. And if I'm convinced that the cause for the pain in the markets is really removed, that's when I will sell that UVXY position. At this point, it's just way too early to make that call. All right, here's my 3 favorite cryptocurrencies. So I'm going to zoom out a little bit just so you can see this extreme performance. So Polygon's the most aggressive cryptocurrency position that I'm bullish on. It's come down from 1900% return to 870, and it has smoked Ethereum and Bitcoin by something like 20 times the return. If you're familiar with the Lightning Network for Bitcoin, Polygon's basically the Lightning Network for Ethereum. So they work hand in hand. We don't have Polygon in our high risk portfolio. We do have a private equity fund only for paid members. And we've got about a third of our assets long Polygon to outperform being long Ethereum. If we zoom in here, we can see how correlated all these assets are. And these are my favorite growth assets for this decade. Okay, it's Bitcoin, Ethereum, and Polygon. Without question, I think you get far better returns in these technologies than you would simply in the Nasdaq. And again, it's because these are much younger technologies that are growing rapidly, but they've been around a lot less time. So, and they're global products that are out of the reach of governments in general. Okay, so here's the inflation print coming up Thursday. I believe it will be less than, I think it'll be 6.5 or less. And if so, the markets will be okay with that. The bond market won't sell off. So if it's higher than that, the bond market could very well be upset. And if interest rates rise, we're now seeing about a 48-hour delay. When we see the TLT crash by more than 2%, for whatever reason, What used to happen immediately is now taking about 48 hours. And then we're seeing that volatility strike into assets that are sensitive to bond yields, which is the Nasdaq and cryptocurrencies at this point. So that's my expectation. If we go below 6.5, it'll probably be a bullish environment for markets. If it goes above that, then there's gonna be more pressure for the Federal Reserve to be more aggressive with hiking rates. But with this war excuse, maybe they won't be. Maybe they'll continue to drag their feet. So that's the only data point that I believe is worth looking at. We had a strong jobs report, but the jobs reports have become a joke because they completely revise them a month or two later, to the point where it's the exact opposite of what they've reported previously. So I think this is the only economic data that really makes a big difference outside of energy costs. So that's where I have my full focus now, is when will energy costs fall? And what's the inflation rate going to be? And what's Powell telling us he's going to do with central bank policy? All right, let's take a look at the Fed's balance sheet. Still didn't crack 9 trillion, so it actually went down a tiny bit last week. They most likely will add to it this week. I think one last time next week, and then that should be the top of the U.S. Balance sheet. So $8.9 trillion. I would expect Europe to not get very hawkish with policy at all. So probably a great opportunity to buy up Russian stocks and European stocks and emerging market stocks right now. Blood on the street, more money printing, more easy monetary policy. So that's the ECB's balance sheet currently. All right, we're going to go into portfolio track records and the trade alerts we see coming. But if you're on a free trial, this is where your video ends. You got to upgrade to get the sell alerts and gain access to the software. So you can punch in how much money you have. It'll tell you exactly what to buy or sell. So call Dean now at 505-322-7515 to upgrade.